When it comes to housing bubbles, the bigger the bubble, the bigger the pop. That's what Australia is probably experiencing at the moment. A large deflation that isn't showing any signs of slowing down. It was once thought that it was just a healthy but overdue correction, but now regulators, policymakers and the Reserve Bank of Australia are all beginning to worry. Although the current slide hasn't shown too much of a threat to the broader economy, even the most conservative of observers are suggesting that prices will continue to fall, at least until the end of 2019. The biggest problem is that the main causes of the downfall cannot be altered easily. The only tool left in the RBA's arsenal is another rate cut. But many commentators have argued that such a cut will only ease the pain, not cure the affliction. It's not dissimilar to a morbidly obese person who takes fistfuls of medication every morning to help them with their lower back pain. The pain may be temporarily gone, but they still have a high risk of stroke, diabetes and coronary heart disease. Yes, the Australian housing market is the unhealthy fat man of the Western world. There are two major forces at play here. One, tighter credit conditions, and two, a looming supply glut. Slashing interest rates will not fix either of them. Some pundits have argued that banks should just go back to the days where they made it easy to borrow money, open up the money tap and let it flow. That is, go back to the days of irresponsible lending. Easy cash equals increased asset prices. But that's simply not going to happen anymore, at least not anytime soon. The banks have tightened their lending standards, rigorously checking borrowers' ability to repay, something they should have done all along. However, the cash party is over, and it's directly affecting the housing market. As expected, the RBA is worried. They used to be of the opinion, she'll be right, but unfortunately that's no longer the case. On Friday, 12th of April 2019, the RBA made a number of dire warnings regarding the property market, the first being negative equity. There's a risk that falling house prices will push some borrowers into negative equity, that is, the amount owing on their mortgage will be higher than the value of their property. Currently, just a tad under 3% of borrowers are in this situation, but if the housing market continues to slide, this number will only get worse. Due to the wind-back of the mining boom, the states most affected by negative equity are Western Australia, the Northern Territory, and my home state of Queensland. The RBA also warned of the risk of unemployment. They said, unemployment would increase the risk of costly defaults for lenders, compounding the somewhat tighter availability of credit seen to date. Greater reduced credit supply would be detrimental to the economy and to financial stability. Income shocks will affect the financial system. But to be fair, the RBA also mentioned that the market would have to fall significantly further in order for negative equity to become widespread. The current unemployment rate of 4.9% is offering some protection against mass mortgage default. For comparison, in the lead-up to the subprime mortgage crash in the United States, there was a negative equity rate of around 25%. Ireland, where property prices fell between 30 and 50%, had a negative equity rate in excess of 35%. The RBA's Financial Stability Review optimistically states that despite Australians having a high household debt, many Australians would still be able to service their mortgage after losing their job because of accumulated prepayment buffers, whatever that means. If it means savings, I don't think that many households have any savings. If it means other assets that can be sold off, such as a car, then I think most people are screwed, because their cars are probably still being paid off as well. If people start losing their jobs in large numbers, I don't see where they can get the extra money from to continue paying their mortgage, except possibly from family. But clearly this would have a huge economic toll. The RBA have also noted that the rate of households making excess mortgage repayments has fallen. That is, people simply don't have the extra income to pay off their loans faster. But despite all of this, the RBA ran some stress tests that have shown that the banks should be able to withstand a fairly bleak decline, where unemployment reaches double digits and housing prices fall more than 30%. There are other factors that could potentially hurt the Australian economy: trade tensions between the US and China, a sudden rise in official interest rates, and a potential for a hard economic landing in China. Here's a graph showing the slowdown in growth of the Chinese economy. It's currently at 6.6%. Its slowest growth in over 28 years. However, you should be warned, these are the official figures from the Chinese Communist Party. Whether we should trust them or not is another matter. And finally, the risk of cyberattack. The RBA stated, Australian financial entities face key risks from their large, complex and interconnected information technology systems. These are subject to disruption for a range of reasons, not least of which is cyber attacks. Such attacks are a constant threat to the financial sector and, while a systematic event is unlikely, it could have severe consequences for the financial system. As many of you have probably heard, China are suspected to be behind many of these attacks, despite the Communist Party saying otherwise. The looming housing glut is certainly on everyone's minds. This graph from the investment bank UBS shows the number of dwellings in Australia over the past 60 years that are under construction. You can see that unit construction, in blue, has increased dramatically since the housing boom began in around 2009. Ultimately, this oversupply will affect prices. The RBA stated, the time between apartments being pre-sold and completed can be long, often a couple of years. When circumstances change between the date of pre-sale and completion, there is a risk that some buyers will not go ahead with purchasing the apartment. Settlement failure. Most buyers of off-the-plan apartments need a mortgage to pay the balance when the apartment is completed. The amount they can borrow is constrained by the bank's valuation of the property at the time of completion. If lenders' valuations are lower than purchase prices and banks reduce the amount they are willing to lend, buyers may need to use additional savings or loans from other sources to complete the purchase. If these so-called settlement failures were to increase, developers would be stuck with unsold but completed apartments. This will obviously affect their cash flow, increasing the likelihood that they can't pay back their loans, potentially leading to either them severely reducing their sale prices or going bankrupt. Developers have already started to fear a glut. In the March quarter 2019, new construction has already dropped by about 16%. Moody's Analytics has made a prediction that house prices, especially in Sydney, Melbourne and Perth, are set to continue to slide for the rest of 2019. Melbourne is set to lead the price slide with a loss of over 11%. Sydney and Perth are the next big losers at losses of about 9% and 6.5% respectively. But despite all of this, Moody's predicts that by 2020, house prices will start to recover in all capital cities. I don't know how they would know that, but certainly time will tell. With regards to the effects of lending conditions on the market, Moody's analysts wrote, investors have been relatively more impacted than owner-occupiers in the past 3 years amid tightening of lending conditions that has contributed to the slowdown in home values. As investor participation had already slowed, national home values would be expected to reach a slightly deeper trough and have a slower recovery, particularly in the markets where investor participation is higher than the national average, including Sydney, Melbourne and Brisbane. Westpac analysts are probably slightly more optimistic. Westpac's Matthew Hassan stated, overall, the February update was a little firmer than expected, consistent with the improved tone from auction market activity and a slowing in price declines in recent months. Some of the effects of tightening credit conditions may also be dissipating. That said, the signs of improvement are still only tentative. The market may be starting to find a base in terms of finance activity, but conditions remain weak overall. It's certainly not looking good for older Australians either. Our entire retirement system was built on the notion that most retirees would own their own home. This is simply not the case anymore. Research from the Grattan Institute shows the share of over 65s who own their home will fall from 76% today to about 57% by 2056. For low-income retirees, it will be significantly worse, with less than half who will own their own homes in the future, down from more than 70% today. The Grattan Institute stated, home ownership provides retirees with big benefits. They have somewhere to live without paying rent, and they are insulated from rising housing costs. These benefits, which have the fancy name of imputed rents, are worth over $23,000 a year to the average household, which is pretty much equivalent to the maximum pension. The Grattan Institute's 2018 report titled Money in Retirement warned of the risk of renting during one's retirement years. It stated, renters are more than twice as likely as homeowners to suffer financial stress, as indicated by things such as skipping meals or failing to pay bills. As housing affordability becomes a real issue among retirees, renting will become more widespread. More and more retirees will be at risk of poverty and financial stress. particularly if the Australian government's rent assistance program does not keep pace with the actual increase in rents paid by low-income renters. Traditionally, the maximum rent assistance is indexed in line with the Consumer Price Index, but rents have been rising at a much faster pace than this for a long time. Between 2003 and 2017, the Consumer Price Index rose by 41%, but over the same time period, average rents rose by over 64%. Something's not making sense here. Looking at the actual rent assistance amounts for families, you can see that for a family with 2 children, like myself, to get the maximum fortnightly payment of $161.14, you have to be paying at least $452.57 in rent every fortnight. That's about $226 a week. Now tell me where in Australia you can get cheaper rent than $226 a week for a family of 4. We're in a tiny little flat in a regional centre and it's costing us $275 a week. I can only assume that rents in the capital cities are much, much higher. The Money in Retirement report also stated, "There's another important implication. Retirement incomes are likely to become more unequal in the future, and rising housing costs will in time force retirees to draw down on more of the value of their home to fund their retirement." House prices have simply outstripped income growth over the last 25 years. In the early 1990s, median house prices were around 4 times annual income. Now they're more than 7 times. In Sydney, it's more than 8 times. Anyway, that's my rant for today. Housing prices are falling, at least for the rest of 2019, even if you consider only conservative estimates. Retirees are struggling, more and more people are renting, the financial future isn't looking any brighter for the average Australian. What can be done about it? I don't know. Some people say just vote for Labor, or the Greens, or whoever else, and everything will be fixed. Somehow, I doubt that.